Bob, if we look at the ramifications for asset allocation sort of through the lens of the highly inflationary period in the late 70s and early 80s, what are some of the lessons learned from an asset allocation perspective through such highly inflationary periods?
Yeah, I mean, I think the biggest thing is um, most portfolios, if you look at how they're built today strategically, we're sort of talking constructing a beta portfolio, sort of putting our alpha views on the side. If you look at beta portfolios today, they're basically built on the lessons learned from 1985 to 2020 or 2022, right? Like that's kind of how they're built. And how are they built? They're basically bonds and stocks, which were a great set of portfolio diversifiers over time, over that period. And in a disinflationary cycle, that's exactly the portfolio you want to hold. But I think it's really important to recognize that that is a terrible portfolio through an inflationary cycle. And the vast majority of everyday investors are totally unprepared to experience this dynamic because they're not holding assets that would typically do pretty well in inflation upswing as well as the downswing following an inflation upswing. So things like commodities, industrial commodities, oil, gold. And that sort of combination of assets is going to do better than a set of assets that's highly concentrated in disinflationary cycle. Now, to be clear, that doesn't mean that assets in general are going to do well. It just means if you're going to protect yourself as well as possible, you're going to want to have that portfolio of assets.
So